Hey guys, Omar Khan here with Theta Trading, and today's topic of discussion is the top 7 mistakes beginner investors make. And I can tell you out of my own personal history, I have made every one of these mistakes. So don't feel bad if you made these mistakes. The idea here is to educate and inform so that we have a better financial future. Before we get on to today's topic, if I could ask you guys a big favor, if you could hit that like button, it helps promote our video to more people who are looking to get financial literacy. And get themselves and their families off to a better life. Consider subscribing to the channel if you find the content to be valuable, and leave us a comment. See what other videos you'd like to see, okay? Now, I want to delve into today's topic. Top 7 mistakes beginner investors make. And again, like I said, I've made every single one of these mistakes. So let's go with number 1 here. So the first mistake is not investing at all. You're too scared, okay? You're like, I don't know, is it the right time? Is it not the right time? Not quite sure what to do. Not investing is one of the biggest things you can do. Now, what those people tend to do is they tend to keep their money in the bank because it feels safer to them. But let's talk about what happens when you have money in your bank. Now, I'm not saying don't have money left over for a rainy day. What I'm saying is you don't want to have a lot of money in your bank account. You want to have your money working for you. The idea here is if you leave your money in the bank, and let's say, we're here in 2023, the last 2 years, inflation has run around 7-8% a year. And if the bank is offering you 2 or 3% in interest, what's happening is your real purchasing power is actually decreasing, right? You can buy less stuff with the same amount of dollars, right? And on top of that 2 or 3% that you're making, you may have to pay taxes on that. So what's happening is your purchasing power by leaving all that money in your bank is eroding. Now, what it does do for you, however, is psychologically it makes you feel better. A lot of investing is about the psychology, how you feel. So one feels better because you look at your bank account, you're like, oh, I got a lot of money in my bank account. I feel great. I got money for a rainy day. But here is the reality of it, okay? The reality is, and it can be summed up in one statement, wealthy people have their money working for them. Non-wealthy people trade their time in for money. That's essentially what it boils down to. And what I want you to get in the habit is, and I've been where I've had no money working for me, and now to the point where I have, enough money working for me where I don't have to work anymore, which is a great spot to be in. But there's a process to it. It takes time, right? You want your money to be making more money than you, because money can be replicated. However, you can't. Your most valuable commodity is time, right? So begin early. Don't leave too much money in your bank account and get that money working for you, okay? Let's talk about number 2. Number 2 is not having an emergency fund. You should have an emergency fund set aside for you in case things don't go your way, because all of a sudden things can get really bad economically. Things are really good one day, and then all of a sudden next day, there's a big recession and you're scrambling. We don't want to be in that position, right? Because what that will force you to do is sell your assets at a low point in the market. Now, I left my job about 10 years ago, and I was able to do so because I had enough of my investments working for me. And at the time that I left, we had 3 young kids at home, a 6-year-old, a 4-year-old, and a 2-year-old. Imagine coming home to your wife and saying, I'm never going back to work again. Well, the reason I was able to do that is because I had financial literacy by then. I had a lot of money working for me, and I set aside at least a year's worth of living expenses. So that no matter what happens, we have a year's worth of expenses. I can take this risk. And that is a big mistake that beginner investors make. Okay? So make sure you set aside at least 3 months of living expenses on the side just in case something happens. You should have that even now, right? I still have a large amount that I keep on the side to this day, just because you never know how bad things can get, right? Okay, beginner mistake number 3, trying to time the market. There's an old saying in Wall Street, nobody knows where the market is going to go short term. Nobody knows, not even Warren Buffett. If Warren Buffett knew, he would buy at the absolute bottom and sell at the absolute top. Nobody knows which way the market is going to go in the short run. In the short run, the stock market is a popularity contest. It could blow any which way based on human emotion. If humans are in a good mood, they'll bid a lot of assets up in price. If they're in a bad mood because the economy is bad, assets will go down. Ultimately, in the long run, what matters is earnings and revenue. The amount of money a company makes or doesn't make. That's what ultimately will drive the markets higher. That is what you want to focus on, okay? Now, I want to show you a graph here and why it makes sense investing, okay? And why you shouldn't try to time the bottom. I want to show you here, right here. You can take a look at this article here. Stock market returns since 1950. Now, if you invested $100 in the S&P at the beginning of 1950, you'd have 241,000 and change at the end of 2023, assuming you reinvested all dividends. This is a return on investment of 241,000% or 11.25% a year. Now, let's talk about that. The S&P 500 has gone up 11.25% a year since 1950. That's a good number. That means the stock market goes up over time, as you can see from this graph below. So if you're not investing, okay, and if you're trying to time the bottom, it's not going to be easy because the bias is upwards. The markets are going up over time. So for you to time the bottom, it's almost impossible. The one thing I will say here is this. When others are fearful, be greedy, and when others are greedy, be fearful. So when you see the most amount of pain out there, right, that's when you want to become opportunistic. That's when you want to have more money working for you. And when you see everyone talking about something, oh, this real estate market's going nowhere but to the moon. The stock market's going nowhere to the moon. Everyone's buying. That's when you want to be more cautious, okay? Number 4, investor psychology. Start slow. What that means is when you first start investing, you're not going to be a seasoned investor. There's certain things that only experience will teach you. So when you first start investing, don't invest with all of your life savings. Start off slower and increase that as you gain more confidence. You will start to understand the psychology of the market. You'll understand the ebbs and flows. Now, if you take a look at that chart that we showed in the previous section here, and from 1950, the markets have done lots of ups and downs. I've been through 3 major market corrections in my time since the late 90s, and big ones, 01, 02, 08, 09, and right now, this is the 3rd one. So what you want to make sure you're doing is you want to start slow so that you understand how the markets work. They go up, they go down, you get used to it from a psychological viewpoint, and then you understand when there's a lot of fear out there, that's when you want to be opportunistic. And this takes time to learn. It doesn't happen overnight. So I would say start slow, increase as you gain more confidence, okay? Number 5, compounding. As Albert Einstein said, compounding is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. Now, what that means is you want to be in the market long as possible. Start investing early. Don't start late in life. The later that you start in life, the longer it's going to take you to get to your goals, okay? So if you start investing at 20, you're going to need less every month. If you start investing at 30, you're going to need more. If you start investing at 40, you're going to need even more by the time retirement comes because you have less time for that money to compound and work in your favor. So you want to start as early as possible. I was a bit of a late starter. I started probably in my late 20s investing in terms of real money anyways. I dabbled obviously before then, but I didn't have a lot of money back then. And one of the things I tell people now is, start as early as you possibly can. That money will just compound and compound and compound, and that is a spot you want to be in, okay? Now, let's talk about mistake number 6, account for taxes, okay? So if you're going to make money on your investments, you want to take into account the taxes that you're going to make. So if you collect dividends, for example, here what we do at Theta is we collect a lot of premiums. I'm going to get into that in number 7 here. But you want to account for taxes. Make sure you set aside some money saying, okay, I made X amount of dollars this year. I need to set aside some money to pay taxes. Also, take advantage of tax favorable accounts. In the United States, you have a Roth IRA, you have the 401k. In Canada, you have RSPs, you have TFSAs. Look where you can make investments that are in tax-friendly environments. Maximize those first, and then try to minimize your taxes after that. Because at the end of the day, what matters is how much you take home. And always keep aside money for taxes that you may owe the next year. Now, why that's such a big mistake is you could have an excellent year like 2021, okay, where you make a ton of money. You're making all kinds of money. You're like, oh, I'm making a bunch of money. And you don't take into account taxes. And you take all that money and you roll it into your account. So you keep it in your account. And all of a sudden, 2022 comes on. It's a horrible year. And now you have to owe the taxman or the tax person. You got to owe the government, okay? And if you don't have that money aside, what's going to happen? You're going to have to sell your investments off at a low point in order to pay that tax obligation. So keep into account taxation, okay? And in my opinion, number 7, which is the worst mistake of all, and not many people know about it, is learn about naked puts and covered calls, okay? Learn how to invest your money. That's exactly what we do here at Theta Trading. If you want to learn more about what we do here at Theta Trading, book a call with us. We'll explain. Watch some of my previous videos on naked puts, covered calls. This strategy will literally change your life. Most people don't like to take time to actually become financially literate. They just want to leave my portfolio autopilot. Yeah, my guy does it, or I just invest into an ETF every month, or whatever they mean. An ETF actually is a much better idea than actively managed funds. In my opinion, learning how naked puts covered calls work are absolute life-changing. What that means is if you identify a stock that you want to buy or an index, let's say, for example, the S&P 500, that chart that we looked at earlier. And did you know that if you simply agree to buy that stock, or in this case, the S&P 500, for a lower amount, if you guarantee it, you can make a ton of money? This is life-changing. It's the ultimate side hustle. So if you don't know about naked puts and covered calls, learn about them from my previous videos. But this, to me, is the mistake. That is the biggest mistake. Not becoming financially literate and not learning how to take advantage of something like naked puts and covered calls because you simply don't understand them. Take the time to learn them. The reason I say that, again, also is because mutual funds can be really expensive. I just did a video on that. Mutual funds can run you in excess of 2.5-3% a year. Now, we talked about this. The S&P 500 has averaged 11.25% per year since 1950. But if you're paying 2.5% of that to a professional money manager, it's going to be hard for them to beat that 11.25% because it costs so much. You're paying 2.5% a year no matter what happens. They get paid no matter what happens, whether they do well or do poorly. So that's going to come off of your return. So I say, learn about naked puts and covered calls. Learn how to invest on your own. It's a life-changing skill. I hope you take me up on that. Anyways, guys, that's the top 7 beginner investor mistakes. I've made them all, like I said. I hope you don't. Until next time, guys, I hope you guys enjoy this video. Let us know what other content you'd like to see, and we'll talk soon. Take care. Bye-bye.